Nilkant Mishra, Head of Equity Strategy with Credit Suisse, joins us from Hong Kong. Nilkant, good morning. Thank you for joining us. Nilkant, first a word on the Credit Suisse Global Investor Conference. What is the mood at the conference, and how would you map the big picture for Indian markets? Do you think that valuations are looking attractive after the recent corrections, or in the near term macro concerns and political concerns will clearly have an impact on market sentiment?
The correction so far has not been meaningful enough or large enough. So I don't think there's been a very meaningful change in the valuations. But yes, the Indian market has been among the worst in the world this year. In local currency terms, at least till a week back, it was 50th out of 50 markets. So on a relative basis, I think India does look slightly better. But the mood among investors remains quite negative. In fact, in the survey that is done for investors, which I don't know how representative that is, but at least most people did say that they were still underweight India. I don't think that is very representative though, because a large number of investors that are very India focused may not be here.
Nilkant, in your last conference, interestingly, the crowd sentiment was bearish in 4 countries, which included India, which was among the best performing market in the region at that time. So where does India figure in this time's crowd sentiment?
As I said, the people are still significantly underweight India. But that comment about people being underweight and India still doing well, I think the start and the end points that you got don't seem to be right. The conference last year was again in March. If you were to do March to March, India is, I would say, 40th out of 50 markets in the world. The performance that India showed almost all of it came in the first 6 weeks of 2012, which was actually a reversal of the late 2011 performance. So no, I don't think it's really a contrarian indicator as you seem to be making it out.
In 2013, despite flows, Indian markets have not really performed that well. Is it fundamentals finally catching up, according to you?
They have to. See, over a period of time, I think earnings do matter. What matters in the short term is, of course, flows. The reason why the first 3 months of flows this year have not really had much of an impact is primarily that there have been significant local redemptions. So as most investors, most India watchers know, especially the domestic insurance funds have been seeing people switch out of equities in large numbers. The equity AUMs for many of these funds has come down quite meaningfully. And therefore, this has offset the large FII inflows that have happened. So therefore, we've not even seen near-term impact on the stocks. But yes, on a 12-month basis, what really drives stocks is earnings. And I think earnings downgrades have again started. We expect FY14 earnings will be down 8 to 10% from here.
Nilkant, you conducted an interesting discussion on India's reform proposal. That is the question I guess everyone wants to know. Will the government keep foot pressed on the reform accelerator, or will politics dominate the Indian economy in next 9 to 12 months?
We did have a panel discussion. I think there were 2 very eminent speakers, Mr. Gurcharan Das and Mr. Shekhar Gupta, very avid India watchers and very intrinsically optimistic people on India. Their view was that one should stop expecting a very strong center. So India, as they say, has really never had a strong state. So to expect that we will suddenly turn into a China and have very strong decision making being driven from the top, I think that's quite impractical. I think we will continue to have, if you recall, and that's my own view, if you recall, even when the so-called star NDA government, which drove a lot of reforms, while that government was on, it still seemed very chaotic. So reforms will happen. We have also in our report in November shown that reforms are largely independent of who is in power. And even if there is going to be a hung parliament in whenever the next elections happen, we think it's going to be earlier than scheduled. I don't think the reform momentum will be really impacted. What's also important is that in the next 6 months, I think politics will be very important. State governments and central governments will be preparing for the elections, and you will see the government spending a lot more than normal. You'll be seeing a lot more of posturing, a lot more of realignments. We are seeing the first signs of that already.
So Neelkant, what would you advise your clients to play this market with? Which sectors offer attractive risk-reward trade-off according to you?
There are, the way we look at it, there are three parts of the economy. There is the investment side, there is the middle income consumption side, and there is the lower income consumption side. I think the first two sides have weakened. There is a contagion effect, I would say. This is a very vicious phase of the cycle where consumption is weakening because there's not enough job creation, because investment cycle is not working, and the weakness in consumption is then driving further slowdown in investment. This is mostly for the middle income side. But we have put out a very interesting report last week called the Silent Transformation of India, where we show how bottom-up productivity improvement is happening in India with the spread of rural roads, the spread of rural electrification, the spread of cell phones. We show, for example, that chicken farming or poultry has created more jobs than Narega, which surprises most people that we talk to. Between 2005 and 2010, 3.8 million people started doing poultry farming, and that itself was actually created more person days of work than Narega. So if people want to blame high rural wages on Narega, they should blame the chicken as well. The same thing happened for vegetable farming. The same thing happened with the opening of grocery stores. So there is a very nice, very healthy, strong, sustainable growth which is happening away from the big cities. The villages are urbanizing much faster, and that's something that's going to sustain growth, and I think that part of consumption will remain quite robust. So the investors should be focused on stocks which are going to benefit from a weaker rupee, because that form of consumption is going to be worsening the current account deficit, and they should be looking at stocks which are more focused on lower income consumption growth.
So Neelkant, let's really talk about some key features of that wonderful report, the Silent Transformation. You've chosen about 6 stocks to play. Could you walk us through the rationale here?
Yes, so the broader theme was that if rural wage growth continues and land price appreciation, which a lot of people in cities think is unwarranted, and we've given very strong fundamental reasons, for example, clear land titles, using land as savings because people don't trust the banks, the spread of roads, which intrinsically brings up the value of land. These are things which are creating this wealth effect. But the 80% of the people in India who own less than 2 acres of land, what matters is wage growth. And we have shown how wage growth is very sustainable. The way to play this, you have to be very cautious on not getting into companies which are going to get hurt by the dramatic slowdown in the middle class. So as I said, the middle income consumption is weakening. So we've chosen cigarettes as a category. So even in the middle income category, unfortunate habit of smoking means that even if price increases do go through, the volumes don't get impacted as much. But in the rural areas, there is a very strong inflection point that happens with wage growth. So that gives the companies a lot of pricing power. They can take prices up 20% but not see any impact on volumes. We have flagged other consumption stocks which are far more lower income focused. We've also flagged NBFCs. So there are companies that finance light commercial vehicles, small commercial vehicles. So as the consumption in a village of items that are brought in from the nearby town starts to increase, the demand for light commercial and small commercial vehicles goes up. Now there are not too many auto stocks that are pure plays on that, so you go for an NBFC that finances them. So those are the themes, those are the creative ways in which you can find very good investment ideas.
Right, so if economic growth is sustainable, question is at what rate? Closer to 6.5% or 4.5%?
Yeah, so in the 80s as well, when by most means the reforms were still yet to come, India's economy was growing at more than 5%. And it is the really low base where, just increasing the number of STD and ISD booths actually drove a lot of productivity improvement. And there were other things that happened. The government is spending a lot more. In a similar way, I think this silent transformation of India will actually improve the base of GDP growth. So if it was left to the first two sides that I talked about, the investment side or the middle income consumption side, we would perhaps already be in recession. But it is this underlying growth. So I think 4.5% or so should be pretty much the floor. I don't think we're going to do 6.5 for quite a while. But I do think that on a sustained basis, on a full year basis, and we could see a few quarters of sub 4.5 as well, but I think on a full year basis, 4.5, 5 is pretty much the bottom.
What is your stand on IT? Because this is one sector which has seen maximum amount of upgrades. How exactly are you telling your clients that they should position themselves in large cap IT? Yes, we have been very positive. Last year this was a call that didn't work. This year, thankfully, it is doing extremely well. Our view is that there are three drivers for this sector. The first is that you have to see good dollar revenue growth. So what we are seeing, and this is the reason why we really went out with a very aggressive call on the sector, that we see the capex cycle in the US recovering, which should improve the dollar revenue growth for the sector and therefore increase the P multiples for the sector. The second driver is the currency, and we remain quite negative and worried about the currency. We don't expect there will be a crisis, but we do expect a very steady depreciation of the currency over the next couple of years. And the third driver is the weakness in the middle class. I mean, in a very strange and a sad way, it is a play on the weakening of the middle class, because job creation has slowed. The entry-level salaries for engineers into IT companies remains unchanged for 5-6 years. In real terms, they've actually fallen off. They may be at the levels seen in the 90s. So this gives a lot of margin strength. So if you have a weak currency and very low wage rates, that gives you a lot of margin room to grow volumes or to just grow profits. So these are the three reasons why we like the sector. And yeah, that's the heaviest overweight.
So Neelkant, what about the banking sector? Because of late we witnessed weakness there. Is it time to accumulate though?
There are select stocks in banking that we like. Financials is a large sector. You can't go to zero weight on that. So there are stocks and sectors, as I said, there are some NBFCs, for example, that I pointed out in the silent transformation report. But on the whole, we fear, our banks analyst fears, that there will be a slowdown in loan growth. There will be continued pressures on the net interest margins, and the asset quality problems are not really behind us. In every quarter you hear that the NPAs have bottomed. I don't think they have. We don't think they have. And I think the sector is actually our heaviest underweight.
Neelkant, if I look at your current declared model portfolio, you hardly have any representation from a large cap auto stock, and there was also no representation at the conference from the auto company. Any specific reason why you think that autos are not looking all that positive?
The volume slowdown, because see, this sector, the auto sector, especially the four-wheeler and two-wheeler sectors, they are very focused on the urban middle class, and I think that part of the Indian economy is going to continue to get squeezed for a while. Over a medium term, I think two-wheelers will still make sense because they will benefit from the growth in low-income consumption. But I think four-wheelers in general, I think the volume pressures are likely to continue.
Right, you track the currency as well, Neelkant, pretty closely. What trajectory do you expect the rupee to chart in the rest of 2013?
Look, taking a monthly view on the currency is extremely hard. It's pure speculation. But yes, the pressures on the current account deficit, the reasons why we have those pressures on the current account deficit, I think will continue for a while. We will continue to see reasonable inflows, which is why my view on the markets, my view on the economy may be quite negative, especially except for some parts. But the view on the markets is not as negative because I think flows will continue, but they may not be able to offset all the current account pressure. So I think the rupee, should weaken by 4% a year over the next several years, because some of the challenges I see for the current account are not going to go away in a hurry.
Lincoln, good having you on the show. Appreciate you taking the time out and joining us on the show.